You have $50 in your account right now. Not a lot. Barely enough for a decent dinner and a tank of gas in most cities. But here's what almost nobody tells you. That small, almost meaningless amount of money, if handled correctly, can become the most important financial decision you make this year. Not because $50 is impressive, because what you do with it reveals whether you're still playing the old game or whether you've started playing the one that actually builds wealth in 2026. Most people will spend it, some will save it. A much smaller group will put it to work. Today we're going to walk through exactly how to invest your first $50 the smart way. No hype, no complicated strategies, just the mechanics that separate people who stay stuck from those who quietly begin building something real. The truth is uncomfortable. The financial system is designed so that small amounts feel irrelevant. That's how they keep the game going. Because once you realize that $50 invested intelligently and consistently can become thousands over time, the entire story changes. Let's start with where we are right now, in 2026. Inflation continues to erode the value of cash sitting in regular bank accounts. Everyday costs, rent, groceries, fuel, keep climbing faster than most wages. At the same time, the markets have continued their long, uneven march upward. The gap between those who own assets and those who only earn a paycheck has widened again. And here you are with $50. It feels small, but it's not. It's the beginning. Step 1. Understand what you're actually buying. When you invest $50, you're not buying a lottery ticket. You're buying ownership in pieces of the economy. The smartest way for most people starting out is through low-cost index funds, or ETFs that track broad markets, essentially owning a tiny slice of thousands of companies at once. Think about it like this. Instead of trying to pick the next big winner, something even professional investors struggle with, you own the entire haystack. In the United States, funds that track the S&P 500 have historically returned around 7 to 10% per year on average over long periods after inflation. That's not a guarantee, but it's a proven pattern across decades of crashes, booms, wars, and pandemics. Your first $50 won't make you rich next month. That's not the point. The point is starting the machine. Step 2. Choose the right place to put it. You have options in 2026, and some are significantly better than others. Brokerage apps have made investing easier than ever. Many now allow you to buy fractional shares, meaning your $50 can go straight into high-quality funds without sitting in cash. Look for platforms with zero or very low commissions and no minimum deposit requirements. A practical choice for beginners, a total stock market fund or an S&P 500 tracker. Simple, boring, effective. Avoid the temptation to put your first 50 into a single hot stock or cryptocurrency. The odds of that money disappearing are much higher than the odds of it exploding upward. The quiet winners don't chase stories, they own the market itself. Step 3. The hidden power. Most people never use. Here's where the real mechanics begin to show themselves. That first $50 matters less than what happens next month, and the month after that. If you can add another $50 every single month, even when it feels painful, the mathematics start shifting in your favor. Let's look at the numbers without the hype. Suppose you invest $50 every month starting at age 25. Earning a conservative 7% average annual return. By age 65, without ever increasing the amount, you're looking at over $120,000. Change one variable, start at age 35 instead. Same monthly amount, same return. You end up with roughly half that amount. 10 years of delay costs you an enormous difference. This is the part the highlight reels never show. Time is the most valuable variable, and it becomes dramatically more expensive the longer you wait. Step 4. Protect yourself from your own brain. The biggest risk to your first $50 isn't the market. It's you. Markets will drop. They always do. In 2022, broad indexes fell more than 20%. In other years, they've fallen even harder. The people who lose money long term are usually the ones who sell in panic when prices drop, locking in losses, then buy back in when prices feel safe again, usually much higher. The smart move is almost absurdly simple. Keep investing the same amount every month, regardless of whether the market is up or down. This is called dollar cost averaging. It removes emotion from the equation. It forces you to buy more shares when prices are low and fewer when they're high. Over time, it works in your favor. Step 5. Build the habit before you chase perfection. You don't need to understand options trading, technical analysis, or macroeconomic forecasts to begin. You need consistency. Set up an automatic transfer so that $50, or whatever small amount you can protect, moves every month without you thinking about it. Treat it like any other non-negotiable bill, because in many ways, it is. The irony is that the people who feel they don't have enough money to invest are often the ones who need the habit most. Starting small removes every excuse. $50 is small enough that almost anyone can find it. It's also large enough to begin changing how you think about money. The broader picture. In 2026, the economic environment remains challenging for people who only rely on wages. Asset prices continue climbing. The cost of living keeps rising. Governments and central banks manage their own problems, often making things more expensive for regular people over time. Those who own even a small piece of productive assets position themselves on the right side of that equation. Your first $50 won't change your life tomorrow, but it can change the trajectory of the next 10, 20, or 40 years. The system doesn't care if you start with $50 or $5,000. It only notices whether you started at all and whether you kept going when it stopped feeling exciting. Closing. Most people will watch this, nod along, and do nothing. They'll wait for the right time. More money, better understanding, less stress. But the right time is almost always now, not because markets are perfect, but because time is the one thing that never waits. So here's the real question, the one that actually matters. What are you going to do with your next $50? Will it disappear into another month of normal life? Or will it become the first brick in something much larger? The machine doesn't need you to be rich to start. It only needs you to begin. Don't close this and forget it. Open your phone right now and take the first action while the idea is still fresh. If you're in the US or using international friendly platforms, download or open an app like Fidelity, Vanguard, Schwab, or Robinhood. In 2026, these still lead for beginners with zero commission trades and fractional shares. Search for a low-cost ETF that tracks a broad market index. Put your $50 in, confirm the purchase, screenshot it. That single confirmation shifts you from spectator to participant. What to expect in the first year month 1. Your balance will probably look almost exactly like $50. That's normal. Month 6. Small ups and downs, maybe a few dollars of growth or loss. Year 1. With consistent $50 monthly additions and average returns, you're looking at roughly $620 to $650. Still small, but you now have data, a login, and proof that you can do this. The real payoff isn't in year 1, it's in year 10 and beyond. Common objections. Handled. I'm still paying off debt. Fair. Keep attacking high-interest debt first, but even $25 to $50 a month into the market while doing so builds the habit. Many people do both. I don't understand the market. You don't need to. The beauty of broad index funds is that professionals manage the details. Your job is just to keep feeding the machine. Markets might crash. They will. But every crash in history has eventually been followed by new highs. The people who built real wealth bought through the crashes, not after them. One final truth. In 2026, the biggest wealth transfer of our lifetimes is still happening, from those who only consume to those who quietly own pieces of the future. You don't need permission. You don't need a finance degree. You don't need to wait until you feel ready. You already have the $50. The only thing left is the decision. So right now, before you swipe to the next video or scroll away, open your brokerage app, transfer the money, buy the fund, set up the automatic monthly transfer. Then tell someone, a friend, your partner, or even post it anonymously, that you started. Speaking it out loud makes it harder to quit. Your future self 10 years from now won't remember the exact market conditions in July 2026. But they will remember the month you finally began. This is how ordinary people become wealthy. Not with one brilliant move, but with one small, smart, repeated decision. You've got the script. You've got the $50. Now go make the first brick. The machine is waiting. It only needs you to begin.